Credit card debt in America has just hit a record $1.21 trillion.
Credit card debt is at the all-time high. It's never been like this.
U.S. credit card debt has just hit a record high, $1.21 trillion in debt.
Americans are still spending, owing a staggering $1.2 trillion in credit card debt.
Delinquencies are rising, reaching 2008 great financial crisis levels.
Rising default rates on credit card loans now at the highest level since just after the 2008 financial crisis.
The number of accounts with delinquent balances has more than doubled since 2021.
And more Americans are missing payments every month.
Credit card delinquencies are at their second highest point since 2011.
Nearly half of all Americans have a credit card balance they are unable to pay off.
Half of American cardholders now carry credit card debt, and many people have no plan to pay it off.
A lot of people still have a lot of credit card debt.
Consumers are spending more because things cost more.
In many cases, making the bare minimum payments.
A record high number of people are only paying the minimum monthly payment on their credit card bills.
How are we going to solve that?
And now, lawmakers are moving forward and advancing a cap on credit card interest rates of 10%.
Congresswomen Alexandria Ocasio-Cortez and Anna Paulina Luna introduced a bill that would cap credit card interest rates at 10% nationwide.
We're going to put a temporary cap on credit card interest rates at 10%.
A move that they claim will help struggling Americans. But will it, or will this situation just backfire like many efforts in the past? Scenes from the 2008 banking crisis where banks were denying loans. In response to that tight lending environment, investors saw a big opportunity. And hey, I'll lend that money at 15, 20, 50, 100, 300, 500% interest. Payday lenders, installment lenders started opening up locations all across America to capitalize on this massive pain being felt by consumers. If history could teach us one thing, it's that in situations where there is top-down government control and regulation, a black market will form, and this black market generally is worse for the consumer.
People making well over six figures are still living paycheck to paycheck.
Wages haven't kept up with the cost of living by and large for the last 50 years or so.
There's storm clouds, they're big storm clouds, it's a hurricane.
History shows that price controls often have unintended consequences. So before we celebrate, let's talk about what this actually means for your money, your credit, and the future for tens of millions of Americans. Before we get started, today's video is sponsored by my company, GreatCreditFast.com. That's GreatCreditFast.com. If you are looking out at the world and you see a significant rug pull likely incoming, where we're going to see the rich get a lot richer and a lot of money moving hands, if you want to be a part of that, and invest in distressed real estate, get a business loan, take advantage of massive opportunities, make sure your credit score is in line with your goals. So if you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative or derogatory item in your credit report, go to GreatCreditFast.com. That's GreatCreditFast.com. As the world changes and gets harder, it's going to get harder to get a loan. So if you have bad credit, you want to get that squared away now. Book a free strategy session below by clicking the link. Now back to today's video. Gas prices are up. Food prices are skyrocketing.
It is not your imagination. You are paying more for goods and services than you were a year ago.
Cost of food and energy continued to climb in January, hitting 3% for the first time since June of last year.
Figures driven by increased costs of groceries, gasoline, and rent. Egg prices surged by 15.2%.
And the credit card balances for most Americans are just growing. Then you hear that the government is here to help and to cap credit card interest rates at just 10%.
Americans are drowning in credit card debt. Now there's a new push in Congress to cap credit card interest rates at 10%.
Lower interest rates means lower monthly payments. Sounds like a relief, right? But if lawmakers force banks to cut interest rates to 10%, banks and credit card companies, they won't be able to cover the default risk. And that's when things get dangerous. Some states are already drowning in unpaid credit card bills, and this could make it even worse. For instance, Mississippi has a default rate of 39%, followed by Louisiana at 31.7% and Alabama at 30.5%.
Financially, things have definitely been a struggle for me. I don't know how, but every single month I somehow managed to get by.
65% of middle-class Americans said they were struggling financially.
I do like cereal, but I haven't bought a name brand cereal in quite a while.
The American South in general exhibits a higher delinquency rate. Gas prices are up, food prices are skyrocketing, with Texas at 25%, surpassing other populous states like Florida at 14.8% and New York at 14.9%.
Prices are rising higher than was expected. Consumer prices rose 0.5% in January on a month-over-month basis, but a 3% year-over-year.
The meal services for ready-to-eat options are up 4.4%. Baking items up 2.8%. Candy, gum, 6.2%. Grain, beans, and pasta up 2.2%. Egg prices are now more expensive than at any point in the last decade.
In these regions, capping interest rates could lead to banks reducing or eliminating consumer lending. And this is happening as consumers are already facing their own set of financial challenges. Millions of Americans, especially young Americans, small business owners, and lower income households could lose access to credit completely. Right now, the average American holds a $6,580 credit card balance.
Our society is currently engulfed in the largest debt bubble in history, which continues to expand every month.
Average of $6,580 in credit card debt.
And it's only getting worse month after month. But here's the bigger problem. Job losses are rising. In February alone, 172,000 Americans were laid off.
U.S. job cuts skyrocketed 245% in February.
172,000 layoffs were announced in February. That is twice as much as what we saw last February.
This is the highest since March of 2020. So people are losing jobs and they're racking up credit card balances. And now the government wants to cap credit card interest rates. But what happens when banks stop lending? And this isn't just speculation. We have seen this before. From the 2008 Great Financial Crisis, the government stepped in and imposed regulations on lending. The net result? Less lending, more secondary options like payday loans, installment loans, car title loans, and predatory lending products. And simply a financial system that becomes even more challenging and expensive for everyday Americans to navigate. But the bigger problem is that Americans are already struggling with debt. Credit card debt sitting at $1.21 trillion is likely only going to continue to grow. Today, 40% of Americans say they use their credit card to cover essential expenses like food, rent, and medical bills.
63% of workers say they wouldn't be able to cover a $500 emergency expense.
Most people don't have $1,000 in the bank.
Americans now carry more than $1 trillion in credit card debt.
Over 7.2% of credit card accounts are 90 days delinquent. And when people can't pay, they either default or file bankruptcy. And that costs banks and lenders billions of dollars annually.
Silicon Valley Bank, Signature Bank, and First Republic are among the largest bank failures in U.S. history. And experts say more could be at risk.
This data is going to make it even more likely they're going to pull back on lending. Banks don't lend money for free. They assess risk and lend on it. The big question they ask themselves is, what are the probabilities of getting this money back? If a borrower is seen as high risk, the interest rate goes up, the lending limit goes down. They want to balance their risk with losing money on that loan. But if you have very high credit with low consumer debt, and you're viewed as a top tier borrower, 750 credit score, what are you gonna get? 15%, maybe even 0% interest? They want that relationship. They want to build something with you over the long term because they believe they're gonna get the money back on those loans. And they believe that you're gonna be a responsible partner inside of this lending relationship. But if you have bad credit and viewed as irresponsible, your interest rate may be 29%, or on a retail credit card, maybe 34, 35%. Why? Because they view that specific borrower as high risk with a high probability they'll never see that money again. So they want to make up their interest right off the jump and charge as much as they possibly can to offset that high likelihood of never getting that money back. So if the government caps credit card interest rates at 10%, banks can't cover the risk anymore. So instead of lending to high-risk customers, they cut that out entirely and will completely deny applicants they view as risky, which today is many Americans. The average credit card APR is 23%, and people are falling behind. If you were to take out a $10,000 loan on your credit card and make a $250 minimum payment every single month at 23%, it would take you 6 years and 5 months to pay it back, including over $9,163 in interest. So over nearly 6.5 years, you pay back not only the money you borrowed, but almost the same amount back in interest. But we've seen this before. In 2007 and 8, banks were forced, many would say, to lending to risky borrowers, assuming home prices would only go up, incomes would only go up, and we were walking into the golden age in America. Then the housing market crashed and everything changed overnight. Millions defaulted, over 7 million Americans. Banks collapsed, and the entire economy spiraled out of control.
The worst day on Wall Street since the crash of 1987.
The Dow traders are standing there watching in amazement, and I don't blame them.
We're now down 43%.
Almost everything there completely wiped out.
All of us as financial reporters, we were watching to see what would happen with the U.S. housing bust.
50 million people had mortgages roughly at that time out of 75 million homeowners when that bubble burst.
If we force banks to lend under artificial restrictions, we can see a similar consequence in a different form. If banks stop lending, people just won't stop needing money. They'll look elsewhere. And that's where payday loans, installment loans, and car title loans will come in. The average payday loan APR is 391% interest. That's 17 times more expensive than a credit card.
You're more likely to pay much more interest for a payday loan than you are a personal loan or even a credit cash advance.
This is the real danger. When you make credit harder to access, people don't stop borrowing, they just turn to the next available option. Instead of forcing banks to lend at rates in which don't make sense, here's what actually needs to happen. We need to expand financial education programs so that people better understand how to manage their debt and spending effectively. Push for better lending transparency, so borrowers aren't surprised by how much they are spending in interest every single month, how much that coffee will actually cost, how much that vacation will actually cost based on the minimum payments in which people are making. A schedule, so people can digest that information every single month that they get their statement in the mail. We need to create better alternatives to payday loans, so people aren't forced into 400 and 500% APR payday and short-term loans. And here's the biggest hack. If you pay off your balance in full every month, you'll pay nothing, no interest at all.
So you avoid credit card interest by paying off your statement balance each month.
Now, why I believe this is a very bad situation that could be incoming is that if these loans get restricted to 10%, banks will greatly halt lending to most Americans and pull it out of consumer lending entirely. Now, this situation could become a very big problem and a very big opportunity. It depends on what side of the equation you're on.